to July's edition of SFI Not So Live with me, Jay Evans. Got a stellar panel again to talk about the mortgage property industry as we do every month, and a new guest for us this month as well. So we'll introduce Jane in just a second. But first, let's go around the room. Tony, a little introduction from you, please.
Yeah, morning everybody. My name's Tony Hall. I'm Head of Business Development here at Saffron for Intermediaries, and my role is basically making sure that our proposition delivers across everything that our brokers want it to do.
Wonderful. Thanks, Tony. Phil, good morning.
Morning. I'm Phil Lawford, National Account Manager at Saffron for Intermediaries. And I support Tony in his role and make sure intermediary partners are looked after.
Thanks, Phil. And a new face, a new voice on the podcast for this month. We have Jane Simpson. Jane, good morning. A little introduction from you, if you can, please.
Morning. Yeah, I'm Jane Simpson and I'm the Managing Director of TBMC. So TBMC are a buy-to-let specialist, master broker and packager. So we help brokers to place the difficult buy-to-let cases that they're getting through.
Ooh, nice little topic for you later on then. Great stuff. It's so good to have you with us, and we'll certainly head towards your market as well as we're talking, I'm sure. Just a little caveat for anyone that hasn't listened to SFI Not So Live before. We are a panel of people with our own opinions, not necessarily that of our employers. And we try and keep it on topic, as it were. And we've got a lot to talk about this month, as we can tell from the first story that's come in, and we're going to talk about. And this is Jeremy Hunt's bank measures to help mortgage holders following the latest Bank of England hike of interest rates to 5%. I don't think anyone in the country has not heard this story. So, Tony, what did you think of his interventions? I put a tweet out and got abused because I said, oh, look, the big banks are in. There's no building societies in there, because it was very much tailored to big banks. But that's my opinion. What was yours?
That's quite common whenever there's it's degrees of scale. Look, the large six cover off 90% of the market. So those are the ones most affected by these scenarios in terms of quantum. This is going to sound awful, but I'm a bit disappointed because we're making what is a market norm just over a cyclical period into a crisis, and it's not. That's what's really frustrating me at the moment. Rates go up, rates go down. It's just we've been in a very benign low bit for quite a while. Now, I accept that there is some big impacts on people. So I think the measures are helpful, but let's not make it sound like this. We've never done this before in a scenario where rates have risen like this. So, it's setting a dangerous precedent for lenders. Ultimately it's supporting borrowers, but it's also making it harder for lenders where there are true cases of someone not paying their mortgage, and you're carrying that loss or carrying that restriction for even longer. For us as a building society, where it's our members that are impacted by our losses, because it means we don't have the investment to get things better for our members. So it's a challenge, really. But the biggest thing for me is, great, it's happening. Some of the rules, it sounds great to say this, but trying to do it in practice as a lender is not easy. Mm-hmm. And that's what every lender at the moment who signed up to the charter is currently doing, and running hard to try and make that work. And we're no exception to that. But it's more the fact that rates go up and down. That's the market. And I hate the fact that we're sensationalising it still. That's my big deal.
I agree to a point. I agree with you a lot. And obviously with the wider cost of living crisis, everyone's struggling a bit. So I think there's perhaps an element of that in there. But yeah, so obviously the house prices aren't going down. So obviously there is that impact, and salaries aren't going up as quickly as everything else. So there is a sort of wider issue. But I think I agree. I think it has been a lot of focus on mortgages and not on other things that can be affected. Phil, I presume there's a mirror as to what Tony said?
Yes, so some of it. I agree we shouldn't be sensationalising it. Obviously, a lot of this is forbearance measures that actually will just reading some of the details, I think most lenders were doing some of it already anyway. Certainly,
Yeah,
we were all doing it during the pandemic period, so nothing majorly new. So I don't. We sort of bigged it up possibly to be something more than it's not really. So again, let's take a bit of a chill pill about that and just calm down. Because I think there's a lot of understandable sort of tensions. People are worried at the moment. Uh, I think we need the market as a whole needs to be calm. It's really easy to talk ourselves up into a frenzy and that talk ourselves into recession, and let's calm it down a bit. But I think you raised a good point, Jay, is that the mortgage market, or it is only a small, or it's a significant set, but it's only a segment of the population. So whatever
yeah,
we're doing to, I know, try and calm inflation and everything, it's such a small segment. There's a lot of people who don't have mortgages, and that renters, people in social housing. So it seems a very blunt tool to try and calm everything down, and that's why. And the world and the mortgage market is in a very different place to sort of 25, 30 years ago as well.
Jane, there is a knock-on effect. Obviously, your market, buy-to-let market, the rate increases are putting, it's increasing the costs for landlords, which is then going to have to knock down, as Phil was saying, on renters. Renters are getting affected too because rents are having to go up to compensate, and so actually renters are massively affected. And actually, some of their rents are a lot higher than the mortgage amounts to pay. So your market's particularly affected by this, isn't it?
It is affected. I don't think it's completely just the bank base rises that it's affected by. So for us, I think it's really the affordability or the ICR calculation, which derives how much somebody can borrow. And at the moment, because swap rates are so high and bank base is a big driver for that going up, we are finding that the biggest challenge that landlords have at the moment is actually being able to lend the amount of money that they want to borrow. So, whether it's like for like remortgage or whether it's a purchase, we are finding there's more and more deals coming through where actually, because the rates are so high, they can't actually get the borrowing out. So that means they're potentially stuck on an SVR. So it's having that knock-on effect. As I said, that's not completely driven by the bank base rate increases because they will, it'll incorporate things like inflation and other things that are going on in the money markets. But it is having a knock-on effect. I think most landlords, because it's a business, it is slightly different. You're not so emotionally attached to your mortgage. So I think most landlords will take the higher rates if they can. It's just whether or not they can actually get the deal to work on the amount they need to borrow at the moment.
Oh, that's fair. That's fair. Just on Jeremy Hunt getting involved, on the chance to get involved, Tony, you alluded to this. Do you think it's really necessary for the Chancellor to step in like this? Is it? Because Tony, what you said, and I think this is really relevant, he's sensationalising it, putting the Chancellor in front of banks just because rates are going up a little bit, when actually he should be concentrating on the wider economy and on inflation and on things that are really affecting people. Do you think this is necessary, honestly?
No. Well, look, it's necessary from the fact that he's getting it in the ear from Labour and the Liberals around this, and they're coming out with horrendous headlines like mortgage rates is equivalent of a 2% increase in income tax, and stuff like that. So he can't. It's almost backed into a corner that you had to do something. Because they were quite clear a few months ago, look, we're not going to get involved in this. Mm-hmm. And then that's all of a sudden U-turn. So, okay, then we'll do something. So I think, I think back to Phil's point, lenders do this anyway. The pandemic taught us that. We all of us really looked at it there and made the right measures and allowed the payment holidays, allowed the extra forbearance. So that's the sensational, as Phil was saying, is that these new measures don't really change much. apart from the fact of having to repossess someone's property. But if you're at the point of going for repossession, right, it's very unlikely that person's ever going to come back from that anyway. So you are just delaying the inevitable, which is great for that person because they're in the house for a bit longer, which is good and allows them to sort their life out. But yeah, it's so I think short summary, I think he's been backed into the corner, and is doing his best to now make it sound like it was all his idea. And isn't it wonderful?
It's funny, actually.
I think lenders are being a bit underrated. Sorry,
Jane, carry on. No, carry on.
I was just going to say, I think that lenders are being a little bit underrated here. Like you say, they would have done this anyway. No lender wants to repossess somebody's property. And we've just got consumer duty coming in. So lenders are really geared up for helping consumers. I'm sure that in all lenders, all the staff have been through huge amounts of training with consumer duty coming in and how best to help customers, and whether that's payment holidays, going on interest only for a period, whatever that might be. I'm sure all lenders treat it differently, but the customer just should be signposted to the lender, I think, to deal with it internally.
And I think that's a bit, Phil, you probably agree here, that's a bit of an issue, isn't it? In that I don't think a lot of consumers feel that they can go to their lender. They can, but I don't mean feel they can, and like you don't mean welcome, but I think there is an anxiety, a kind of a negativity towards going and saying, look, I'm struggling. Is there anything you can do for me? Is there anything that I can do to make this easier? And I think, look, just thinking of myself and my sensitivities, I would be a little bit embarrassed to call and have to ask for help. But I think we need to really just make sure that the borrowers know that they've got the help available to them, don't we?
Yeah, I think it's a really good point that, as lenders, we always say, if you are experiencing difficulties, act early, act quickly. Don't bury your head in the sand for 3 months because then it's sort of a bit too late. The sooner you intervene with a problem, you can sort it. And I think we've always said that. That's nothing new. But yeah, it's probably a good point that probably needs to be a better communication piece to consumers about engaging, and that's probably where mortgage brokers can come into play as well. Is very often your mortgage broker is the first point of contact with a lender or that bridge with the lender. So I think if brokers can, if they're coming to somebody speaking to their mortgage broker saying they're struggling, can you help me? Then talking to engagement with the current lender is always a really good option, and probably we as lenders we need to be more conscious of that as well.
I put a story out and I forgot to put a link to it, but I'm just going to read some stats to you. It was from Mortgage Strategy. It was titled 1 in 10 mortgage holders unable to afford payments if costs continue as they are. Some of the stats that come out here are quite interesting. 1 in 7 will, not plans to, but will need to ask for a mortgage holiday. 1 in 10 would need to temporarily switch to an interest only. 6% have said they would need to sell their home, so very, very low. So there's not, this was opinion research. It wasn't by any brand. It was actually just a research company that did the research on it that they published in a Mortgage Strategy. But I think, people are saying this because it's in front of them. But actually, I think, going back to what Phil just said, it's the fact that talking about mortgage holidays and things that can happen because of the Chancellor got it on all the papers. And so actually it raised the profile a bit. But I agree. I think the lenders are a bit more flexible than perhaps we give them credit for. And I think that this has actually put a negative to lenders.
Look, I'm looking at this article. You've got the quote from the Liberal Democrat Treasury spokesperson, this is a sticking plaster for a gushing wound, right? Let's scare some people a bit more. Even after today, bailiffs will still be knocking on people's doors because the government refused to help. That doesn't help, really. And it makes it makes the government sound weak, and you can take your own view on whether you think they are or not. I'm not going to offer a comment, but it makes us sound as lenders like we're looking to kick people out, which is just not the case. But as Phil said, go and speak to someone early. There's no stigma in going, I need help. It's the same as it's a different issue, but mental health and the stigma around saying I need help for that. Financial help, which is a big driver of mental health, is just as important. Go and find somebody that can help you. And if you owe someone money, the best thing to start with is speak to them, right? If they take the wrong view, then you need to go somewhere else, and there are plenty of sources available for people for that. But just come and speak to us. There's so much we can do to help and give you advice on what you think about. Think about the other thing, I suppose. The other slight point to this is people are saying I can't afford my mortgage, but are they still paying for their Netflix and Amazon Prime and Disney Plus and all the other things that actually are discretionary spend? What's more important? Your house. Now, I know in some cases they've done all of that, and this is still absolutely killing them because of the cost of, that horrible decision of, do I turn the heat on? Do I have a hot meal for my kids? Because of that. And that is horrendous. And that's the ones we really do need to help. Mm-hmm. But it's that discretionary spend. I think everybody's got to have a look at that and make that call as well. It's tough. It's horrible. But back in the day, that's what you had to do,
Back in the day, though, Phil, I know you're going to have a comment on this, but back in the day, we had education on how to handle our finances. Nobody in this generation that are coming through have had any education on this. So they wouldn't know that help's available to them. They wouldn't know that lenders are good for them. They wouldn't know how to look at their bank accounts and check their spending because nobody's teaching them anything. There's nothing in education. Well, Phil, I've triggered you.
Yeah. No, I think we mention it on most of our podcasts. Financial education in schools is really important. And that's, again, it's a massive part that the broker community can play is giving that until it comes through, until we start doing it more in schools. But brokers can really add value to their customers by helping them. Going looking through budgets, bank statements with them, and helping them make probably better informed decisions. And that's. I think that's really important. Yeah. I think the other, going off at a tangent slightly, but we haven't mentioned them yet, but I know we will do, is the Bank of England are really concerning me. I think the Bank of England were really late to the party in raising rates. They should have raised them earlier than they did. And now they're not giving time to, not allowing time to make the rate right, to let the rate rises take effect, and that's concerning me probably more than anything, because of 25, 30 years ago, most people were on variable rate mortgages rather than fixed. So if you did a rate increase, then people's mortgages are affected fairly quickly, within a month usually. Whereas now, most people being on fixes, you're only seeing those impacts when they're coming off the fixed rates. And I just don't think we've seen anywhere near the impact yet. And I think the Bank of England they keep piling on these rate increases. We're not going to see that impact until everybody's off the fixed rates.
That's a really good point, Phil. Really good point.
That's really concerning me. It just seems so obvious, but why aren't we talking about that more?
There's no other. They've got no other ideas to combat inflation, but keep putting the Bank of England rates up. That's not the trigger. That shouldn't be the trigger to fix inflation. They should be looking at the market as a whole. Yeah. But it seems to be, let's go straight to the Bank of England. Let's ripe it up a little bit more and make it harder on everybody so they don't spend any money. But actually, why are we not looking at the profiteering in supermarkets? Why are we not looking at the profiteering in energy companies to bring that inflation down? I could go for hours on that. Jane, sorry, you look like you were going to say something earlier. We went off on a bit of a tangent.
I was just going to say that we're talking about 1 in 10 people might not be able to afford their mortgage, but actually the only people that are really going to be affected are those people coming off a fixed rate.
Yeah.
So I think there's 1.8 million mortgages due to come off a fixed rate in the next 12 months. So is it 1 in 10 of those? Because if it's 1 in 10 of everyone that's got a mortgage, it doesn't really make any sense. So obviously that is a far smaller number. And I think for brokers, it's an opportunity to get in touch with those people that are coming off a fixed rate and start talking to them about what their reversion looks like. Does the lender offer a PT? are they able to remortgage, and what might that look like? So you can start helping those customers early on to plan for coming off, so there won't be so much of a shock when it goes on to the SVR, because there are some high SVRs out there, but there are other things that you could do rather than just land on an SVR and stay there.
Yeah, reality is very few people actually stay on an SVR. Very few. Certainly our own base is extremely small, and largely, and we write to them and tell them they're on it, and they're quite comfortable. So, what can you do? But there's different sources. But I think Phil's and James' points there is, there's a lot of people that are on a fixed rate for quite a while. And I think the key here as well, actually, and it's not a dig at brokers, but one of the things we've seen, obviously, and it's been said before, that the last 10 years has been order taking. Is it 2 or 5, right? There's been no real investigation around the impact. But one of the things that the ESIS documentation, so the regulatory documentation that has to be explained to a customer, shows the 20-year position high for base rates. And so you should be explaining to your client that this is the 20-year period high for what the base rate's been at. So this rate has been here, but it's one of those, and I'm guessing it'd be one of those like, that's a 20-year high, but don't worry, we're fixing it. Okay, so I think a lot of that advice, which I'm not saying is wrong advice, but probably didn't go into the depths because it wasn't felt as appropriate because it's a fixed rate and we're in a benign environment. I think that's coming to roost now. With customers being truly shocked by, hang on a minute, I was on 2 something and now I'm on 6 something. So I think that's something else for everybody to consider in the advice that they gave. Did they really make that clear?
I agree. I think another point sort of really linked to that is, I think we need to have. I know we've had this conversation. We had a conversation. The industry had a conversation pre-credit crunch, so we're going back into the early noughties about it. But I think it really needs to come back now to the UK market, is longer term fixed rate products as well, because I know in previous podcasts we've talked about fixed rates in our market in the UK are relatively short term compared to elsewhere in the world, and I regularly track the US market and interest rates just because I'm a bit sad, but it interests me. Long-term interest rates in the US are starting to come down now, which I thought was really, again, is quite interesting. While as we look at stuff here in more of a short to medium term, so I'd like us as an industry to have a big debate about, can we make longer term fixed rates work, because then you've got certainty. I know there's disadvantages, and we need to talk about things like break clauses to get out what happens if you want to sell the property, but I think that's something that is probably it's the right time to open that debate up in our industry. Not sure how that works in the buy-to-let market. I'd be interested on what you think, Jane.
Yeah, I mean, we've had a few 7 and 10 year fixed rates. The take-up hasn't been huge. I think, ironically, the cost of funds is less than 5 years, so they actually can be priced lower than your 5-year fixed. But I think it is those fears, especially when it's a landlord running a business, of actually, 10 years is quite a long time, and I don't know what I'm doing with my business in that time. So I think, the ERCs maybe need to be looked at within that to make that perhaps more something that seems you can go on it. I think I think we could do with talking about trackers a bit more. Like, nobody wants a tracker at the moment, but we would hope at some point in the not too distant future we come to like the point of the top of the rate rises, and then obviously getting on a tracker is ideal because you're just going to go down and benefit from that. But at the moment there seems to be talking to some of the sales guys in my office, they say, oh, no one wants a tracker because they want the stability. So it's like, but if they fix him for 5 years now at like 6 or 7%, then they're stuck on that rate for 5 years. But if they went on a tracker that might be under 6%, so it might be 5.5 now. So by the time they get to that 6 or 7, we might be coming back down, and then obviously you're going to sort of ride the rate curve back down again. So I'm not saying that's right for everyone, but I think I'm not sure there's enough conversations going on about that. And tracker is just seen as something that is, well, you don't know what you're going to pay, so it's not as secure. But actually, there are benefits, particularly if you're a landlord or a customer that thinks that the rates are going to top out at 6 at the end of the year, and then they're going to go down. Then that might be ideal for you. And if they don't quite top out there, it is a risk, but. Is it as much of a risk? Also, staying on a fixed rate at 7% for 5 years is also a risk.
That's really true.
Yeah. It's we talk a lot about don't discount the discount and the tracker rates, because it's the thing is, people want stability, which I get, but it's about the impact of a rate rise and can you afford it? Because as you say, at the moment, trackers are. I'm on a tracker myself personally, and I'm paying below the fixed rate market, and then there'll be a point where I'll switch over if rates keep rising. But that's the gamble or the risk I can take. But I also know that I can absorb that increase. I'm in a fortunate position, I can, but it doesn't mean I'm overpaying now. So that's the key. It's about the ability of the borrower to be able to withstand those rises until it does tip. If you can't, then fixing is exactly the right thing to do, because you've crystallized your cost for that period. If you can afford a 100, 200, 300 pound increase in your loan over successive base rate rises, it's a perfectly good opportunity to do so, because you're not going to pay as much. But as you say, Jane, but that's where advice, and we always recommend go and get quality advice, because that's when it comes in and really pays dividends.
I think everyone's just a bit out of practice of selling trackers, though.
Yeah, we've seen it.
Yeah.
When this all hit last year, Phil, we had brokers ringing us up going, can you help us explain a tracker product or a discount, please? So they just didn't know how to bring it into the equation.
I've been working with you guys for nearly 3 years, and I couldn't tell you what a tracker is. I'm not an expert. Everyone knows that. I'm just a host, Jane. But I couldn't tell you what it is. So it just goes to show there's not something I've written about, I've even explored, having worked with you guys. So, interesting point. And I'm going to move on to the next story, which is from the FT, because you mentioned, Phil, about selling homes. This is one's about discounting and people discounting. It's from Zoopla. Saying basically that people are offering a discount on a home in order to sell, because the buyers are getting spooked because the mortgage rate's gone up. You know where this is going, Tony. It's crystal ball time. Almost every podcast we talk about lowering house prices and do house prices need to go down. Will they go down? Is it going to happen? But I mean, discounts are one thing, but property prices aren't doing. I read again last week. Oh, they're going to fly down. We're going on a crash. Well, I don't see that coming. Do you?
No.
Look, Nationwide index is out today. There is actually a 0.1% growth in average house price in this month, June to May, but we're still 3.5% down on this time last year. Okay, so it swings and roundabouts. So we're seeing contraction. We're always going to see that. I've never said there's going to be a bubble burst, but there will be a deflation to hopefully a normalization. And there's a lot of more factors now that are going to influence that. The biggest one that Jane alluded to at the start is affordability calcs. Yeah. If you can't borrow what you need to borrow, then you can't buy that house, and that seller can't sell it at that value. So they've got to come down. Otherwise, the market will not move. So it's no surprise that I can see it around here. House prices are going on at the crazy price they think they should be at, but within 2 to 3 weeks, they are starting to drop. And it's 5%, 10%, so we're seeing that. So I think we're still seeing inflated market value over actual. Yeah. Yes, there's a contraction because we've gone through that mental bit and the fact you can't borrow as much anyway because of affordability. So there's going to be a natural drop. But I don't think we're going to see huge swathing negative equity scandals anytime soon, if I'm honest.
I completely agree. I think the Halifax reported a 1% drop as well from the start of the year to May. So again, it's a small readjustment rather than like the bottom falling out of the market.
Yeah.
I don't think we're ever going to fix the house price issue while we've got such a lack of homes anyway. There's absolutely nothing being built, is there, Phil? This is
That was the point I was going to make. I think the best descriptor of what we're probably going to see this year is a tempering of the market. So Jane was spot on with the affordability. That's probably the biggest factor that's going to temper house prices. But as you've alluded to, Jay, we've still got housing crisis at the moment in terms of supply. We've got lack of supply. There's just still, whatever house prices do, there's still the factor that there's not enough houses being built and there's not enough housing stock at the moment to fit all to fit everyone. So whether that's in private ownership, whether you want to buy a property, whether you want to rent. So obviously rental stock's an issue, and social housing as well. So all of those, there's just a fundamental lack of stock, which I know we've talked about on countless podcasts again previously, and what we should do to sort that. But as long as that problem is going to be there, and supply demand, I can't see there being a seismic crash. It's going to be more around affordability, what people can afford to pay, that's going to dictate where house prices land. And also the BBC article this morning, Nationwide, have reported that applications numbers of mortgage applications haven't yet dropped either. So we've not seen that. Now that might be because we're seeing more remortgages because people are trying to get better rates and worried about it. But we've not seen mortgage applications drop yet either.
Have you seen any drop in the buy-to-let market, Jane?
Of applications? I think that there has been a marginal drop. I think some of the lenders are doing really well at the moment because we deal with 45 different lenders, but I would say there's probably 10 that are really able to kind of lend and have rates out there. So I would say those 10 are probably doing what they did this time last year, but it's a smaller pool. So I think that there has been some drop off. A lot of it, I think, is being driven by uncertainty. So conversations, the start of the year, it was very much, I'm just going to hold off and see what happens. And things seemed to get a bit better. So then we had like a couple of really good months where we had a lot of applications coming through. And then at the back end of May, when we saw the last weekend of May, the swap rate spiked. So we literally saw every lender withdrawing their rates. So again, you have a spike where everyone tries to get their applications in. And then after that, there seems to be like a dust settling period where people wait to see what's going to happen. So a lot of conversations are kind of like waiting and see. And I think what's not helping is just the up and down of the markets. I think it's making people feel uneasy. They're not really sure what to do, whether to fix, whether to buy the property. So, and then, think you get this little period of stabilization, people go for it. So I think what we're seeing more than anything is maybe not an overall drop, but like peaks and troughs where we're getting periods where application volumes are quite high and then periods where they're dropping off. So it's just really unstable at the moment.
Just on the other side, Jane, are you seeing many, and I've read a few articles, sensationalizing it slightly, but you see any increase in the buy-to-let landlords selling up because of what's going on? I mean, it's been talked about a hell of a lot, and obviously we've just talked about the fact that rents are having to go up to compensate for the rising mortgage rates. But renters are always going to be around, aren't they? Buy-to-let landlords are the saviour of the market at the moment.
Exactly. Yeah, the private rental sector is so important. So we've been to a couple of events recently this year where we're talking to circa sort of 3,000 landlords in the Excel. And there are some that are going to sell up, but what I would say is most of those are nearing retirement age. And when you speak to them, it's more of, I had this portfolio and I potentially might have kept it to pay my pension, but I've now decided to sell it and use the money as my pension because the markets or because of the government restrictions on landlords. So, but ultimately it's not, your 40 something landlords that's just decided not to be a landlord anymore and they're going to go and work in Asda's. It's the person that was going to retire anyway, and they're just changing maybe their retirement strategy. So there was a bit of that. Also, what I really noticed at the sort of landlord events that we went to was there was quite a high volume of young entrepreneurs. They live in London, they rent in London, so they're a first-time buyer, but they're on a good salary. They've got some savings. They now want to become a landlord. They want to buy a HMO because they want the highest yielding property. So, ultimately we're like, I can't really do a first-time landlord, first-time buyer HMO. So this is the path that you need to take. But it did get me to think that, we're saying we want the private rental sector to be very, we want the landlords in there to be very professional. But how do you get the people there? Because if you've got people retiring out and you've got people that want to be a professional landlord, but it's quite difficult for them to get there for various different reasons. It feels like, and I don't know what that is, but it feels like there needs to be some sort of solution for getting these people. They're high income earners, but on paper, perhaps for a lender, they don't necessarily tick all the boxes. But how do you get them in? Because these are people that want to buy 2, 3, 4 properties. They want to have them house them in a limited company. They want to do it properly. They want to be a professional landlord. But actually, at the moment, they're restricted to, I can only buy a 2 up, 2 down in Nottingham that I've got to rent to a family, and the yield probably isn't going to make me any money. So, it's like, it feels like there's plenty of people to come in. We just need to get them through somehow. It almost feels like you want to marry them up and say, see that guy over there? He just said he wants to sell his portfolio, so you might want to go and have a chat and then get some sort of lender involved, So it feels like a bit missing.
Okay. Well, look, we will talk to you about that, Jane, because I think not that I can fill it, but we're always looking for opportunities to develop our proposition to support the gaps in the market. That's what we're here for. That's our strategic approach. So let's think about that and see if we can come up with something. So we'll talk to you offline. So
Brilliant.
Definitely.
Brilliant.
Oh, look at that, doing business over the podcast. That's a first. And you beautifully led me into the next story, actually, Jane, because this features your market as well, in that brokers are anticipating a rise in buy-to-let landlords from a limited company, which obviously, as you were saying, being more professional with these portfolios, it's a different environment, but actually the tax custom possibilities would drive that increase. But does that counter all the extra measures the government's put in for landlords? Because it's almost like it feels like a balancing act, almost like they're giving them a bit of a tax break, but actually putting more regulation on them.
Yeah, I mean, there is more regulation. I feel like landlords have had a really hard few years with the tax changes, the PRA changes that made it more difficult. And the PRA changes came in to kind of protect the consumer, but actually a lot of landlords just saw that as something that was stopping them from able to borrow the amount they wanted. Obviously, we had COVID in that as well, which would have affected some landlords because their tenants might not have been able to pay. So I feel like they've had a really rough time. They get a bad name as well, and they're good people. But yeah, the tax changes in limited company, we are seeing a massive drive towards limited company. Obviously, they came in fully this year, the tax changes, so landlords can now no longer write off their mortgage payments against their tax. So essentially, they're paying their tax on the pre-mortgage payment income, and then the mortgage payments come out after. So you're paying tax on income, but it's not really income, many landlords would say. So yeah, limited companies are different, and you can write those mortgage payments off. So tax advantages for many, not necessarily everyone, but for many, will be very, very good. What some landlords are also finding is it might even push them into the higher rate tax bracket. So you've got this increased income, so all of a sudden you're paying more tax. So actually your earnings are going down. So there are certain people, obviously tax advice, they need to go to a tax advisor and kind of check that out. The one thing I would say is they need to speak to a broker as well, because we have seen some people that have come to us and had tax advice and they've set up like layered limited companies, or they've got the property in their personal name, but they've got a beneficial interest for the income that goes into a limited company. And whilst on paper and for tax reasons it works out really well, actually lenders won't necessarily lend to them.
You won't get a mortgage on it. Yeah,
it's a 2-part thing where they need to get the tax advice and then they need to go to a broker and say, if I set it up like this, is it going to work? A lender's actually going to lend to me. We've got people that haven't necessarily got SPVs. They just try to do it in their trading company, which will just massively reduce the lenders. So there's lots of if buts and maybes along the way. But I think if the customer speaks to a tax advisor and then speaks to a broker, and the broker can always speak to us if they need that kind of extra helping hand, and then they get it set up in the right way, then it can be very tax advantageous. And also with a limited company, the rental calculation tends to be better as well. So ultimately that might help them to actually borrow more. There are some, setting up is quite easy, but I think there are some costs implicated with the setting up. So, it does need, like I say, it's kind of a two-part: speak to the tax advisor, speak to a broker. The legislation is for personal and limited company. So I think it's whether or not a landlord is willing to do that and whether they want to be a landlord. And if they do, then the option then is the restrictions aren't higher for limited company when it comes to kind of like those government restrictions that we've got in place so that they need to adhere to. So I do think that limited company is definitely something that all landlords should be looking into. Even if it's not right for them, they need to just double check, really, especially this year now that the tax changes are fully phased in, because they've got a really clear picture now of what that's going to look like for them going forward. And we've got some landlords that have got some properties in a personal name and some properties in a limited company, because actually that works better for them. So, it's different for everyone. And I think what we will see is landlords now, they've got properties in their personal name. If you want to put them in a limited company, it's not that easy. You do have to sell them to the limited company. So it's not classed as a remortgage. You can't just pop them in. So things like stamp duty and everything come into play. But what we are seeing is some landlords now using this as opportunity to say, actually, in my personal name, I've got this one particular property that's not really working very well for me. It's not yielding very well. And it's in my personal name. So I'm going to sell it. And then in my limited company, I'm going to buy something different. I'm going to buy a HMO, or I'm going to buy a property somewhere else that's going to yield better. So they're almost kind of like using it as an opportunity to maybe shed some of the properties in personal name that aren't working too well for their business model, but they will then buy some in their limited company to kind of counteract it. So it's an opportunity, I think, to sit down if you are a broker, a landlord, and look at their portfolio, see what they decide is the best route for them, and then how they're going to get the properties in there, and are they going to sell off some. And I know we're not sort of due to talk about it today, but obviously the green agenda as well, with the potential that a lot of these properties that landlords have got might need to have substantial work done on them in the next years. Again, that can be taken into consideration. Do I want to keep the property, or am I going to sell that property and buy something different that's got a better EPC in my limited company, or am I going to raise the funds with a different property that I'm going to sell? So it's kind of like a holistic approach. And certainly what I'm telling my staff is that we shouldn't just be talking to a landlord about one of their properties at the moment. It should be all of the properties, and kind of formulating a plan and becoming that landlord's, business partner, best friend, person that's going to help them achieve what they want to achieve.
I really like that. Good advice. Tony, you're in the limited company space. I remember launching this. How has it been? It was really successful right from the start, wasn't it? It's almost as soon as you.
Yeah, look, it's funny, limited company, because what we get a lot of. I mean, Phil can be more technical on this than me, but we do get a lot of business because of our stress rate and ICR coverage is low on limited companies compared to other lenders. So that works for us. And yeah, whenever we have our rates, we're not a rate-led lender, so our rates are always not going to be there. We're not lending for the sake of lending. We're doing it for the right reasons. So, but the last time we limited company, we did tons of it, and we withdrew it. And funny enough, we're relaunching it tomorrow.
Breaking
or tomorrow. Today is the 30th of June for the purposes of this, guys, so you're aware. So when you hear this, we'll have launched it. There you go, that's easier. But Phil, I'll move over to you in terms of the technical aspects, because I've probably said it all wrong.
No, yeah. So some again, Jane's the expert on this, so I feel very nervous talking about this now.
Yeah, that's why I passed it to you, mate.
That's how I feel the entire podcast, because I don't know anything.
James going to rip me one if I get this wrong, so I'll let Phil take it. Yeah.
Thanks. So some lenders who lend in the limited company space, it's not uncommon for them to have differentiated rental calculations for higher rate taxpayers. Is that right, Jane?
Yeah, it differs lender to lender.
Yeah. So at Saffron, we have one rental calculation, regardless of whether you're a higher rate taxpayer or not. So we have one calculation, which feedback that we've had from brokers using us is that can be advantageous. For like remortgages as well. So if they're just transferring their borrowing to our rate, then we use a lower rental calculation. I suppose it's perceivably it's less risk to us because it's from an experienced landlord and they're not taking any extra borrowing. And if they have a 5-year fixed rate as well, we stress test lower than if they had a shorter term fixed rate, and that's partly due to regulation, mortgage regulation, and so we're allowed to do that on 5-year fixed. So that's a broad summary of it. And I hope I've said everything factually correct.
I think there's a big opportunity for brokers. There were 44,000 SPVs set up in 2022. So 44,000 landlords just last year decided that they were going to set up a brand new special purpose vehicle to put their properties in. So, I think getting on top of your knowledge on that, and seeking out those landlords is a huge business opportunity.
Absolutely. I think that's
long term.
Yeah, no, that's where a company like Jane's company come into their own for brokers who are perhaps less experienced in the buy-to-let and do bits of it. Is that's where talking to a specialist buy-to-let broker and packager like Jane's businesses can really add value.
Yeah, really makes a difference.
Yeah.
Okay, let's move on to our next and last story of the day, actually. And this is from Financial Reporter. It's not actually a story, it's a CPD piece, but I found it really interesting. It was called Understanding the Breadth of Mortgage Options Available to Self-Employed Applicants. Really intrigued by this because it just opens up the market. But I love talking about self-employed, we all do. So let's use this as an opportunity to open the discussion. But first, tiny little plug opportunity for you here. You've got a little something going on self-employed, haven't you? Very soon.
We have, yes. We've got an SFI live exclusively on the self-employed, where we are joined by a broker in this market talking through a case that we were able to help her and a client with. So, I think that'd be good for any broker that wants to understand more about self-employed. Then that's a really good one to listen to at 11 o'clock on the 11th of July. But no, self-employed for us is a huge thing, and it's interesting because there's a lot of research being done, a lot of surveys. These guys have done one. You've got, I know that Pepper have done a self-employed survey recently, and we've done our own. We did a study with 1,000 self-employed customers and their views on what it's like to be self-employed from a mortgage perspective. And I think there's an awful lot of myths that need to be busted. And I think that's what a lot of these articles are telling us, is that the self-employed think they're disadvantaged for being self-employed when it comes to getting a mortgage. In our study, 75% didn't think they could get a mortgage. Further, like I think it was 50% didn't know how to approach a broker to get support. And there's lots of other quite sensational stats in there that from a lender and a broker perspective, we should be sitting up and going, we're failing the consumer here. We're in a position of knowledge and we should be helping these people get a better mortgage, or get a mortgage or get a better mortgage in the rate that they're currently on, because there's this real perception that they can't go anywhere and they're stuck. Saffron, like many other lenders, are very, very flexible with the self-employed. We're comfortable with 1 year or 20 years. It doesn't matter to us. It's the viability and sustainability of your business that we're interested in. But the one thing I want to call out really is that for lenders and brokers to really take a look at themselves and go, what does your website say about how you can help these people? If it doesn't make it really clear that don't panic, there is an option, then perhaps you should, because we know there is an option across the spectrum of lenders for the self-employed. So we're doing a lot of work for us on educating and informing. And I think as an industry, we need to do more to help this market.
Phil, coming to you, we often talk about self-employed, and we've done lots of work on it previously, and it's something we've championed. But what are the major issues? What are the things that self-employed people are facing? Is it as bad as it seems? I mean, there's a lot of doom and gloom, but, are there any real major issues?
Yeah, I think the biggest issue is actually perception rather than reality. So it's that perception that it's a lot harder to get a mortgage if you're self-employed, and it's not. It's perhaps just slightly different, slightly more complicated, but there are a lot of, as Tony alluded to, there's a lot of lenders out there who have specialist products or criteria that lends itself to those areas that can help. And it's not just self-employed. I mean, since COVID, we've seen more people become more self-employed because they had to adapt during that period of time. And working patterns have changed. So you see more 0-hour temporary contractors, day rate contractors, whether that's through umbrella companies or not, or through just through a limited company. And it's actually understanding. I think it's brokers understanding their clients' income or business. So it's understanding the difference between what income will a lender use if they are a sole trader, a limited company, an LLP, or a partnership. So because different lenders will have different approaches. So we've recently tried to make things a lot easier with some criteria changes, and that's the main thing. So we now require far less documentation than we used to. So the documentation for somebody who's self-employed now is exactly the same as if they're employed. So we used to ask for 3 months bank statements. We now ask for a month's bank statements. But I suppose the other bit is getting to understand how accounts work as well. So if you're less experienced with that, and I'm conscious that I'm not teaching brokers to suck eggs, because there's a lot of very experienced brokers out there who know far more than I do about self-employed and how accounts work. But if you are less experienced, then it's getting experience on that, either talking to a broker who's more experienced or reaching out to lender BDMs. And we're happy to talk through how we assess self-employed and how we assess sets of accounts. So it's back to that education bit. As Tony said, myth busting is so you understand that, for that client's circumstances, for that type of business they've got, what income we'll use. And that's, I think those are probably the important factors there.
Yeah, just to pick up on what Phil said there around, because Phil's quite right, our BDMs do get sent on a regular basis sets of accounts saying, how much will you lend to this client? And we're like, that's your job to be telling us. It's not our job to interpret the accounts for you. But that shows that element of nervousness within brokers to truly understand. And that's another reason why you might want to dial into our webinar, because we are going to talk about how to read and understand accounts and what are the common issues that our underwriters come up against when underwriting a self-employed case, to try and again, myth bust, but just make it clearer. I think one of the biggest reasons cases fail, I think Phil has alluded to, is they're just poorly put together. You're not telling us the proper story because of a lack of understanding of yourself or your business. And actually, going back to that research we did, one of the comments from the self-employed is 20% of them felt that brokers didn't understand their business, and therefore weren't able to represent them in the right way. So 1 in 5 were like, I'm not sure if this guy really understands. So, that sounds a bit sensational, but again, it's all down to this, how we educate and inform. But the key for the market for self-employed is don't panic. If you've got a sustainable business, someone will lend you money. That's the key.
Finding the right broker with the right expertise.
Exactly.
Who will match your circumstances with the right lender. It's as simple as that. Yeah.
Jane, conscious I haven't come to you yet. I'm sure you've got an opinion on this. I'm sure some of your buy-to-let people are self-employed.
Yeah, so it's slightly different for buy-to-let landlords, as the amount they can borrow will be derived off the rental. But there is usually a minimum income, and they will usually need to prove it. So I think the biggest things that we see is sometimes, they earn something, but on paper they don't. So again, it's just being a little bit careful about this, like tax efficiency sometimes, because it's all fair and well, you're not having to pay so much tax, but then if it's showing you only earn £15,000 a year when really you earn 60, you're not going to get the mortgage that you want, So I think we do see a lot of brokers come into us, and when we then receive, whether it's the SA302s or the account, you look at them and you say, but this doesn't match the amount that the customer is saying that they earn. So I think, again, that's kind of picking up on that education maybe, where brokers just need to maybe understand a few key parts of the accounts. They don't need to be able to read the whole accounts. It's just a few key numbers here and there that they need to know, they need to particularly look at. But something on buy-to-let, which is quite ironic, I always think, is that some of the lenders are more the vanilla lenders than those that are really into sort of the big portfolio landlords, but they won't actually accept self-employed income, which is solely derived from rental. So that can sometimes mean that the customer, if they are a pure landlord, or if they're a landlord with a job that doesn't pay a great deal, actually their income can be quite high, but it might rule out a number of lenders, which always feels a little bit ironic, especially as we're always
that doesn't rule us out. I just want to plug that. Saffron, don't do that.
Good.
And Matt, we've enhanced that recently, Phil. We used to haircut it, but now I don't think we do we? Or have I just made that up? Maybe that's what we should do.
Yeah, there's some nuances to it. So generally, for most, previously rental income, we'd only use 50% of it, and we don't now. We tend to, as a norm, use 90% now of rental income generally as a norm, with some caveats attached.
Yeah.
And there are circumstances where we'll use 100%. With caveats attached, but that's the broad the broad brush of it. Yeah,
it feels like it's come with us from a time when your 1 or 2 property landlord was preferred to your professional landlord. I mean, I'm sure Tony will remember that time where professional landlords were seen as being quite risky, and those that had 1 or 2 properties were seen as being your better bet. And I feel like that has changed. But perhaps that ruling has just stayed, and perhaps needs to be looked at.
I'd much rather lend to somebody who's experienced, knows what they're doing,
for a business.
than somebody who's more accidental and don't, not experienced in property.
Absolutely.
There's all those pitfalls, isn't it? About property maintenance, how they're going to cover rental voids. Somebody who's experienced and knows what they're doing, they've got that covered anyway.
And I think this is where lenders like Saffron and building societies are really good for the self-employed, because it feels like you're quite well equipped to be able to make those decisions and maybe, change something if it looks right. Whereas some of the bigger lenders, it is a little bit, it either fits or it doesn't. So I think a really good place to start is building societies for self-employed, and some of the specialist lenders as well.
Absolutely.
Yeah.
Well, I hate to be the bearer of bad news, guys, but we've run out of time. That's all we've got time for today. It's absolutely flown as always. It's been such an interesting conversation. I really, really enjoyed it. Jane, thank you so much for joining us. Hope you'll come back again.
Yeah, brilliant, Jane. Thank you.
Thank you for having me.
Yes, please.
And that's it from us. So from all of us, it's a big goodbye for our July edition. We'll be back again in August. Don't forget what Tony mentioned earlier. SFI Live is now a LinkedIn Live. So if you follow SFI, Saffron for Intermediaries, should I say, on LinkedIn, you'll find an event on there. You can sign up and join us for our next webinar, which, as we mentioned earlier, is focused on the self-employed. That's on the 11th of July. Saffron for Intermediaries LinkedIn account. Sign yourself up and you'll get a notification when we go live. So from us for this month, it's a very goodbye.